I thank Mr. Trump, whatever he has done, because he has brought out the beauty of our business model. I have traveled 1.8 million kilometers in the last 3 years.
I used to go and sit in these railway stations and then look at the way the products are moving. And I was entering the password require $49 million. If I had got that move wrong, that was the end of Captain Fresh.
Utham Gowda is the founder of Captain Fresh, a profitable billion-dollar ARR business. Captain Fresh has acquired multiple American and European companies to become a global seafood supply chain giant.
Almost in this whole global fish and seafood new age company space, we almost are like the last man standing today.
Why are you the last man standing? What happened to the other companies?
The biggest handicap of this industry is the industry doesn't know how to raise equity capital. M&As fail largely because of three reasons. One,
Before we start the episode, I just want to tell you that this one is a little different. I first met Uttam and recorded with him in January 2025. That time they were bound for an IPO. So, what you're about to hear for the next hour and a half is the conversation which I had with him last year in January, which still remains super relevant today because it talks a lot of the origin and how he discovered his idea and really formed the thesis because of which today they are almost touching $1 billion of ARR. The second part of this conversation was recently recorded about a week or two back. So that part of the conversation is more about going deeper into the thesis and how it proved out over the last 1 year. Let me know if you think you would like more such long, deep dive kind of conversations. This one is probably going to be a 2.5 hour plus episode. I'm curious, is there an audience for such long format conversations? Utham, you're one of the few first generation founders of a large seafood business. Did you grow up eating a lot of seafood, or how did you discover this space?
Interestingly, my love for seafood as a product to consume and love for seafood as an industry kind of all happened at the same time. And the way I really got introduced to this category is possibly one of the most boring ways any entrepreneur would get into an industry. So I used to be this analyst in an investment bank, and I was tasked to find the next sunrise sector, so to say. And as an analyst, I went out and downloaded all the private company financials, and then I segmented by sectors to find that, yeah, here is an industry which is making sense from an economic standpoint, but not much smart capital, strategic interest has flown in. Why not dive in? So that's how my interest in seafood and my interest with seafood started, honestly.
This is at O3 Capital.
This is at O3 Capital, yeah.
Can you tell me the economic case for this industry? Like you would have done your research and come up with an economic case. What is that economic case?
So the framework was roughly, around is the industry large? So anything that was about 25,000 crore from that standpoint is something that qualified for that framework. And are there companies that are large already in this industry? Again, there were several companies in the 500 to 1,000 crore, 1,000 plus crore mark. The third one is there been consistent profitability in this industry over a 5-10 year period? That's also something that a lot of players qualify. And the fourth one is the return on capital employed profile attractive? Because that's finally the proof of the pudding, right? So here was an industry where all of these qualified. And the fifth one was essentially around, yes, if all of this is true, is this industry still, is it already discovered by the capital, smart capital, or is it to be discovered? So is it about the last 10 years, was there any investment from private equity, or was there any cross-border deals, right? What's the activity like? So those were all the parameters that went into this framework. And coincidentally, if I recall very, very succinctly, seafood did stand out as the top category. And just for completion, I think the other two categories that I had shortlisted, one was flavors and fragrances, which is basically the backend for all your ingredients and FMCG. Third one was spices, the domestic spices opportunity.
Like the MDH market.
Yeah.
Okay. Fascinating. Who are the so you said there are large players in this industry already. Are these players like, say, the kind of names I would see in the freezer of a supermarket, or are these the players who do retail, or are there other types of players also who the retail audience would not be exposed to?
Interestingly, the players who have made it big are the players who have played this business outside India from a demand standpoint.
Okay.
So the intersection of the names that you would see in the retail freezer in India and the players who are large would not be very, very high.
Okay. Who are the last players? Can you name some
So
names?
large players from India would be a Falcon, would be a Avanti, Nekkanti, Devi Seafoods, Devi Fisheries, Sandhya Aqua, Sandhya Marine, Liberty Seafoods, Aswini. So each of the players that I mentioned now are north of 1,000 crores in terms of annual revenues.
And what they do is take raw material from India, clean it, package it, export it.
Correct. So what they do is they're an exporter, they're a processor and an exporter. Their suppliers are the farmers. Their customers end up being all kinds of channels in the US predominantly, and some of them Europe as well. So all your retailers like Walmart, Kroger, Costco could be their customers, or it could be some brands in the US who further distribute to some of the more atomized part of the demand, like a food service in the US or Europe for that matter.
Okay. I've never heard of Indian seafood being spoken about, like, say, you have Norwegian salmon or you have basa from Vietnam. What is Indian seafood known for? Like, is there a type of a variety of fish or something that it is known for? Or
See, largely in the seafood world, you have tropical fishes, which are the fishes or the seafood that thrives in the 20, 25, 30 degrees Celsius environment. Or you have cold water fishes, which thrives in sub-zero, -10, -15 kind of environment.
can you
India
name
is
some
one
names of both
like
of
a
these?
salmon, cod, pollock,
These are
saithe,
sub-zero.
haddock. These are sub-zero cold water species.
Okay.
A shrimp, crab. Crab, of course, has both varieties. There's a cold water crab, there's a warm water crab. Your tilapia, basa, snappers. Some of these are tropical fishes, or tuna
Okay.
for that matter. Tropical
Okay.
fishes. India is one of the most prominent players on the tropical side of the seafood. Now to your point around, you've heard of Norwegian salmon, but you've not heard of Indian seafood, is essentially where the gap is. And to some extent is also where the inspiration for Captain Fish stems from. The fact of the matter is that we have 14.5 million tons of fish that is produced from India. The overall export value from India is just $8 billion. The sum of market cap of all the companies that are doing seafood and listed in India is less than $2 billion. Now, if you contrast that with Norway produces less than 2 million tons. So that is 1/7 the volume of what India produces. It does almost 20 billion also tons of export. That is more than 2.5 times what India does. But the real contrasting part is the market cap. The sum total of all the market cap of all the seafood companies from Norway is north of 30-40 billion dollars, which is 15 times what Indian seafood players total to, right? So this essentially comes from the overall storytelling that the Norwegian constituents have been able to do, and the overall credibility that they are able to put out in the global market, which essentially gets the premium, which translates into value created either at export level or at the market cap level, right? So I would say, yes, there are many products that are out there from the Indian context, but the story needs to be told to a larger cross section in a compelling, in a convincing manner to be able to replicate a Norwegian salmon story
Fascinating.
from an Indian context.
I live in Japan, and I read somewhere that while today the salmon sushi is one of the most popular sushis that you see in a supermarket, but traditionally Japanese people did not eat salmon sushi because raw salmon was considered to have impurities, or it wasn't considered to be safe for consumption in the raw form until Norwegian salmon came along and they possibly told a good story and changed that perception to now make salmon sushi as one of the most popular sushis in Japan, I guess.
I think the way Norwegian salmon players have converted sushi into salmon is itself is a massive case study, because sushi today is one of the largest vehicle for seafood into a consumer palate. And I'm not talking about Japan alone. I'm talking about globally. And they very, very, in a calibrated, deliberate manner, they have conquered that space and in a dominant way. And that itself, in fact, if you ask me, is a big upgrade in terms of their own addressable opportunity. So those are some of the things I would say I would would love to learn from some of these evolved markets, evolved suppliers in terms of truly they've played a very sophisticated monetization game. There's a lot that countries like India need to be inspired from.
How did Norway do it? Any like top level stuff you can tell me? Like, how did they change the game? How did they build that
So
story?
I think one is seafood, but overall at a country level also, I think Norway is one of those countries which has discovered a lot of natural resources after it has achieved its economic freedom, after it has achieved its political freedom, and its democracy has been thriving. As in, just so as a side chat, I'm sure you would know, Norway is one of the very few oil-based economies where there is no threat of dictatorship. It's a full, well-governed democracy at play. It's the
So true.
only, right?
I never
And they
thought
have
of
actually
it that way.
extrapolated the same principle in terms of how to respect nature, how to think long term, how to ensure the structures are built in terms of the interaction between humans and these natural resources, right? So now taking that same principle to fish and seafood industry, they have obviously built a very, very strong licensing system for any of the private players to leverage or use their resources. The resources being yachts. Yachts are basically the cold water hotspots, or so to say cold spots, which gives you a thriving condition for salmon growth. And this is regulated, this is licensed, and it is in a very transparent manner, just like we have, let's say, to 5G bandwidth allocation, right? There is a
Correct.
bid-based system for them to allocate. And then there is a very clear monitoring of the quality of product that goes out of Norway. In fact, if the product is considered tier 2 or grade 2, it is illegal to export out of Norway. And some of these
Wow.
are good on
Okay.
paper in terms of rules.
Fascinating.
Where it gets differentiated is when they are able to enforce these laws, right? So Norway has managed to enforce that law, wherein a grade 2 product can never leave Norwegian shores. Now, when you do this over a compound period of 10, 15, 20 years, it compounds in a form of origin brand.
Okay. So coming back to your journey. So at O3 Capital, you did an academic exercise to find out opportunities, and you spotted three, of which seafood was one. What next?
So after that, I went out scouting for companies that could be interesting for me to work with. I met founders, promoters across the country, almost 15, 20 of them. And then I found one company which was very interesting, company by name Nick Canty, the second generation founder, educated in the US, who had aspiration to transform his family managed business into a very professional setting. So that was an ideal setting for me to say, okay, look, maybe as a banker, I can come and help you get some private capital, and then the board gets reformed, and we can have a path to professionalization and maybe at some point IPO as well. So picked up that
What was
mandate.
Nekanti's business? Was it
So they
exports
were a
only,
shrimp
or?
exporter. So they used to
Okay.
buy raw shrimps from farmers, freeze it, and then sell to the retailers in the US.
Okay.
Right. So I started this process for them, and it was on the private market side. Spent like a year and a half. But during this process, there was this whole excitement in the public market, and they kind of redirected their interest towards listing from a private fundraise. So at that point in time, actually for me at my career, yes, I'd spent some time in investment banking, but somewhere I was starting to realize that it's not compounding enough because you kind of move from one project to another, and you're only as good as your last project. So I wanted to do something that's a little bit more compounding, and clearly moving to industry was one of the options. And like I said, amongst the industries, I had selected seafood, and more I understood about the seafood. I was more intrigued, and I was more convinced that in the long term, there could be a value creation opportunity here. So when this opportunity came about where I could move from investment banking to an industry to help this company, Nekanti, to go public, it was a contrarian call for an investment banker based in Bombay to shut shop there and then move to Vizag with family. But logically for me, it did not seem like that contrarian thought, yeah, it could be an interesting one. So I moved to Vizag, moved to Nekanti. The primary agenda was to get the company listed. That was the core mandate. But I did end up doing a lot of other things around it, like work with sales, work with manufacturing, work on a bunch of things on the supply side. So it was like a little bit like my own tutorial in this industry. And I had this privilege of being part of a cockpit, sitting alongside an operator in a company that is, in its own way, one of the most successful Indian company in an industry which is not that well documented, not that well researched. So it was like a kid in a candy store. It was for me like a great learning opportunity. I went about learning whatever I could along the way for those year and a half. Like I said, my primary mandate was to get it listed, but I ended up doing all of these other things along the way.
Okay, fascinating. Um, what made you want to quit Nekanti? I mean, you could have had a fulfilling career within Nekanti, only publicly listed business. So why did you decide to quit and start on your own?
So along the way, we did not go public. So while we
Okay.
cleared a lot of hoops towards going public, eventually we didn't go public. And for me, it was a question around, okay, should I continue as a professional in a family managed business? Or at some point, I was also inspired that there is so much more I could do in this industry. And I've been fortunate to have seen all sides of it as an outside and inside out. And also, what I was really fortunate about is the whole IPO journey itself, because I was part of the whole team that was meeting these public market investors as part of roadshows. So it's very, very insightful in terms of how an industry which is at a cusp of getting listed, a company which is getting at the cusp of getting listed, how it is seen from public market investor lens. And for me, that was the holy grail of company building, because I believe that everybody builds at some point to get listed, right? So those lessons, those questions, it was very, very foundational for me in terms of driving. Okay, now you have such a great end-to-end learning of how to be built or what is to be built, understanding gaps, even a primer of how a public market looks at it in terms of current gaps, all that. So I thought this is a privileged position to be in, and I shouldn't waste this. I should make more out of this. So the first version of this was not around me building a company. First version of this was actually around me putting together a fund and investing in startups who are at the cutting edge of this industry. I put together a small fund, like a 25-30 crores. Again, it's from the same friends in the seafood industry. More than putting together, I was managing the money of some of these guys in the seafood industry who are aspiring to have a piece of action in the domestic side. Then went about meeting a lot of entrepreneurs who have started business, the usual names in this industry at that point in time. So that gave me a good color in terms of what are the typical problem statements entrepreneurs are looking at and how are they approaching it. Now, I was exposed to the seasoned operators, and now how are new age guys looking at it. And somewhere I thought that I had the best of both worlds. One, I had some second order, third order insights, thanks to being part of a large organization and being part of an industry and exposed to us front end in the US, front end in China, back end some other few other parts of the world. And the fact that, yes, I also had a ability to connect the dots thanks to my consult plus investment banking career, having seen a lot of other mature industries. And this little stint about meeting a lot of these entrepreneurs, evaluating them and seeing, I ended up investing in 3-4 of these companies, by the way. Doing all of these things also gave me a 0 to 1 flavor to this entire thing, right? What would your first day look like if you want to, let's say, decide and want to start the company? What would your 100-day look like, right? So translating all of those big bang PPT slides into those smaller details in terms of how that translates to a real business. So it was a combination of all three that really pushed me over the edge, I would say, in terms of saying that, yeah, I can start. I think the final push was from the old employer, my old boss, who actually stepped up and said, look, why don't you take this amount of capital and use this as seed capital to start this company, right? In a way, he believed that I could be an entrepreneur more than I believed that I could be one. And I think some of these journeys, you need such godfathers. So yeah, so that was the start of Utham as an entrepreneur.
Amazing. So this you're talking about your O3 Capital boss?
No, I'm talking about Nekkanti boss,
Okay.
Venkat Nekkanti.
Okay, amazing. So what did you start with? What was your version 1 of Captain Fresh? What space particularly did you go after?
So version 1 of Captain Fresh, like I'm sure you would have spoken to a lot of entrepreneurs, they'll say, I think I was not clear about what I wanted to do, but I was clear about what I didn't want to do. What I didn't want to do was build a B2C business, right? In terms of taking the fish all the way to the consumers' households. I was very clear on that.
Why is
What I
that?
didn't want to do.
Margin is not enough, or?
No, I think there are two, three logics to this. Yes, I think the margin not being there is a symptom of it.
Okay.
Right? But what is the real problem is that India is, yes, while India, 70% of India consumes meat and seafood, their frequency of consumption is very unique when you compare the world. India is still a Sunday non-veg category country,
Okay.
unlike what you've seen everywhere else, right? It's a three meal protein for everybody else. So how does that transpire? How does that reflect onto the supply chain? Is that those 4 hours in a Sunday or in a year, those 200 hours actually make up for almost 60, 70, 80% of the trade at the country level. Which means that if you are an organized player who is building a supply chain, who's building capacities to serve this demand, you will have such a significant portion of idle time. And if you are over-indexing on B2C, then you are actually building for a service level for those 4 hours. But your capacities are built for the entire week, right? So that intuitively didn't make sense to me, that we can build a great service or brand in this business here in India. And second is, I always wanted to make this a global business. And I clearly knew that everywhere else there is a very, very generous amount of real estate already allocated to this category, and a very efficient real estate. It's not like, there is enough and more pockets of inefficiencies to be unlocked, solved for. So clearly I knew that B2C is not a global game. It's a very India specific Hindu oriented game, which is a Sunday non-veg kind of a thing. So that's what, intuitively I was not drawn to the problem statement.
When you say there is enough real estate allocated to this outside India, you mean to say the freezer space in supermarkets?
So you walk into any supermarket in the US, I'm sure in Japan as well, 1/3 of the real estate is typically animal protein.
Okay, right. True. Got it.
Yeah.
Okay.
The second is I was clear that I don't want to do anything outside of fish and seafood, like a meat or a chicken or any other category. Again, the driving principle was that I wanted to build something global. And I knew that chicken India does not have a right to win in the global marketplace, thanks to its cost structures and the policy choices that we have made. And third is mutton, which is a third largest category, but it's not a global consumption category. Mutton is a very tribal piece, which is popular among some of the, tropical areas largely, like India, some parts around. And beef is something that it's a very different beast I didn't want to be part of.
Can you zoom in on the chicken thing? You said there are some policy decisions because of which chicken is not likely to be.
I think our feed is expensive compared to other markets.
Why is that?
Maybe because we are not allowed to use anything genetically modified. Unlike in other markets. Again, I'm not a subject matter expert, but high level, these were my learnings.
Okay, got it.
But having said that, also industry is far more consolidated. There are already some large $2-3 billion players in the Indian context, not just in Indian context, even in the global context. If you take seafood and poultry are equally sized. Seafood is a 450 billion, poultry is a 450 billion, whereas the largest player in poultry is a $50 billion Tyson. Largest player in seafood is a $5-6 billion player. So even at a global level, the consolidation levels, like top five players for poultry make up for 25% market share globally. Top 5 players for seafood make up for 3-4% of market share. So, that's also a thing that that's the benefit that I had as an entrepreneur. I was very, very analytical, very top down, very, some of these had to make intuitive sense to me from a bottom up data. Only then I would pick some of these problem statements.
I'm loving our conversation so far.
So yeah, those were some of the things that I was very clear I wouldn't want to do. So what I was also trying to do is learn from the existing business models that are out there in the B2B space. So here was a point in time where, there used to be an India Mart or the generation one play, which is a classified business in the B2B realm. It didn't make sense for us because monetization levers are very few in a classifieds business. Second was the overall distribution play, which is the Ninja Cart, Udaan type of players, where that's where I thought that our model fit in, or rather what I thought is a gap would fit in, because India did not have a single large multi-city B2B seafood player. It was a clear gap that I could see. And from a fitment of technology, you have a supply which is fragmented. You have a supply which is very, very non-standard, which is very perishable. And you have a demand which is again very, very fragmented, which is very, very spread out from a geography standpoint. You have an operation which is very complex, like each species, moving one species from one origin to the demand has its own nuances in terms of supply chain. So which meant that if you're running 100 or 200 such supply chains on a daily basis, putting perishable inventory on top of these railroads, it needs to be very agile and flexible and self-correct and all that, which meant that there is some high level use case for technology optimizations, all of that. So that was the thesis, and I saw that playing out in various forms in an Ninja Cart, Udan, and some of these other marketplaces. So that gave me an inspiration that yes, this could be an interesting problem statement to go after. At a global level as well, the gap that I had seen was while the industry was structured as a salmon shrimp play, there were very few players who were actually providing a basket or a seafood as a solution to a customer. And the customer insight that I was relating to is that when you walk into a seafood aisle, you are not really looking for a white shrimp or a red shrimp or a green shrimp or a black shrimp or a salmon or whatever that is, right? You generally have some inclination towards seafood and you would want to buy something in that category. So when you are structured as a species player, whereas the customer sees you as a basket, you will start unlocking lot of layers of inefficiencies at a structural level in an industry, right? So that's also a paradox that kind of interested me in terms of looking at it as a basket and then figuring out a way to unlock supply chains, go back in the supply chain in a digital asset light agile manner. So that was the overall playbook, and yeah, found that as the gap, and that's how I started.
You started global and domestic both together, or?
No, global was not something that I started on day one. And in all honesty and transparency, I don't think I had global as the spotlight the way it is today at the day one. Day one, super excited about India. Started, we grew
Ninja
very,
Cart
very fast, very
model.
quickly. We became $100 million player.
Wow.
We were in a lot of cities, more than 20, 25 cities. We became
one
one
or
of
two
the
questions I want to ask here. So, is seafood consumed as a packaged product, or is it also sold loose? Because I'm from a city and I've always bought seafood in a packet, frozen with a brand and a label and all that. Is that generally how it is, the seafood market, or is it also sold loose? Like, say, chicken, you will buy loose also, depends on personal preferences.
So if I were to describe the seafood demand side, it's one of the most unorganized demand that you can ever think of, right? I spoke about the whole spikiness of seafood demand, right? Even the channels are configured to play towards that spikiness. What I mean by that is a channel typically has two choices to make in terms of how much capital infrastructure they need to build out and how much time they need to dedicate, right? These are roughly the two investments that they do. Here is an industry where all the stakeholders, actors who sell seafood only invest time in this business. They don't invest infrastructure. I think their infrastructure investment is bare minimum. So largely 80% of India's seafood consumption is driven through these hawkers who basically crop up on a Saturday or on a Sunday, do this for 5 hours, 6 hours, and then they disappear from this category. Logically, because like I said, for rest of the idle time, you can't have any real estate. You don't even want to be spending your time. These are all guys who do this as a part-time. They have other things to do when seafood is not the category.
It's right? Like a newspaper route for them, basically.
Yeah, it is. So there are very few channels with a dedicated infrastructure, dedicated cutting, dedicated packaging, dedicated all of this, which is over a 365 days, right? Very few channels. That percentage would be less than 2-3% of India's consumption.
Wow. Okay.
And that 2-3% would have an online play, would have a quick commerce play, will have a modern trade play, all rolled into it.
So these frozen packaged shrimp and fish and all is just 2-3% of the market. Most of the market is
super
hawkers,
tiny.
Roadside
it's
hawkers.
Super tiny. Indian seafood is delivered by hawkers.
Okay. So when you started, which part of the market were you catering to? The organized retail or the hawkers?
So we started with organized. In fact, we started with online. We started with modern trade. And also these are some of the things that I have learned now after 3-4 years, right? When we started, obviously it's not a well-researched industry. We never thought it is just 3% or 4%. We thought it would be much larger, and we discovered city by city. And obviously, Bangalore, you go in and then you tend to extrapolate Bangalore to other cities.
Right.
Reality is that there is only one Bangalore.
The Bangalore
In fact,
bubble.
there is not even one Bangalore. There are only one Koramangala, one Indranagar, and one Rajaji Nagar, one Banshankari, right? Even Bangalore, right? Bangalore also, Yelahanka is so much different compared to Koramangala. You can't extrapolate the same dynamics, saying that if I are doing this volume, this throughput in Koramangala, I will be able to do this in Yelahanka, right? So Bangalore alone is very different. So that's also an humbling experience along the way, right? You raise your Series B or Series A seed basis what you're doing in Bangalore. You think that I have 10 more cities that will follow. And then you land up in Mumbai. Mumbai is a different beast altogether. There is you search for Bangalore within Mumbai, you will not find anything there, right? From an economic standpoint. Same with Hyderabad. Chennai is like a very different beast when it comes to seafood consumption. So that was our experience as well. But the good thing that we did is, I think as a company, we expanded probably in the fastest manner. We failed in the fastest possible manner. We were honest to say that we failed very, very quickly. And we rolled back as well in the fastest manner. So all of this 0 to 100 to 0 happened in almost 24 to 36 months.
Wow. So you give me with timeline and define failure for me. When you say we failed, how do you define we
So
failed?
basically, we started this business in 2020 June. And by the early 2022, we were clocking close to $100 million of throughput.
And you were supplying
in seafood.
To, like, say, a green chick chop or the green chick chop is a North Indian player, but like, say, like a modern bazaar and these kind of stores, or like whom were you supplying?
No, I think by the time we went to 100 million, we were playing across length and breadth. We were delivering to hawkers, wholesale markets, even to a tier 2 city like a Mysore, a Coimbatore. So we essentially did not leave anything to imagination. We went after every possible GTM to essentially say whether we can make money out of this or not make money out of this. So we did this in a span of, like I said, June of 2020, we raised our series pre-seed capital. And over the next 18 months, we did all of this. And this was coinciding with the brutal COVID. And in the middle of COVID, we were expanding cities like there is no tomorrow.
Wow.
And March 2022, we raised our last check of 40 or $50 million at $500 million valuation. And then it dawned upon us that, actually, we have now tried all the GTMs. Hand on heart, we don't have a true business which can justify $500 million valuation. And all the factors that can change this business model are not within our control. Actually, it's a outside in thing. Markets need to change. Counterparty risk profile need to change. Probability for customers to pay in terms of gross margin pool needs to change, right? So all of that hit us. And, when we were really looking at it in a hard-nosed manner. And that also kind of coincided with the whole credit cost going up in the global market, capital squeeze happening, all that, right? So the onset of, admission that we have failed here was the March of 2022. And after that was a year of unwinding, wherein we really stripped our business into pieces that we should retain, pieces that we shouldn't retain, and how we will monetize the pieces that we retained successfully. And that entire shift happened over the next 12 to 18 months. And in summary, that shift was essentially we retained the supply part of it. All the hard work that we had done on the supply aggregation, we retained. And we unwound, we pulled back on all the demand side activities in India and reoriented those resources, energies into demand in the US, Europe, basically the international demand. So it took us almost like a year and a half to move from $100 million India oriented business to a point where we were 150, $200 million global business, and India being almost less than 4-5% of this entire mix.
Okay. I want to zoom in on some of the things you said just now. You admitted that you were not worth $500 million. As an investment banker, what is the calculation that you did in your mind to come up? Was it that we are doing 100 million and this is the expected growth rate and this is the net present value? Was it like that? Or how did you, like, you must have had some
No, see, I
intuitive...
think it's not just in anything that you're valuing, right? In especially a cash flow based valuation is about you having an expectation of certain cash flows, future cash flows, and there is a risk profile for that cash flow basis how risky is it in terms of translating this plan into reality. And when you discount all of those future cash flows by this risk rate, you arrive at a current
valuation,
right? Now, when you project those cash flows, you have a bunch of assumptions, right? The realization that we are not worth it is when those bunch of assumptions start throwing up surprises,
okay,
right? Which starts
give me
affecting
examples.
your future cash flows in terms of what you think is possible.
What are some examples of assumptions which failed?
I think the biggest one is, let's say we said the counterparty risk in India is something where if you provision 2%, you're fine. Basically, you go out and sell 100 rupees of seafood, 2% of that won't come back to you.
And
is a
that
provisioning that
will not come back because it went bad or because
it's because the
must be
customer
dishonest.
is not willing to pay, because the customer segment is a high risk customer segment.
Okay.
It's not willing to pay, and out of every 100 rupee that you do, 2 rupee you may not get back.
And
it's a classic lending discipline where you do a provisioning
NPA.
based on NPA provisioning based on the historical performance of that customer segment.
So what did that come out if it wasn't 2%?
It came out to somewhere around 7, 8, 9%.
Oh, wow. Like
right?
3x, 4x.
So which meant that all of that you would have built around, okay, what is the positive cash that you would generate at a certain scale, right? All of that broke down.
And why is there such a high counterparty risk? Is it normal or?
It's not. See, it's a function of how unorganized the market is. These are all fly-by-night guys. Like I said, these are
newspaper route.
These are cropping up opportunistically.
Right.
If there is any issue with respect to their sales, typically they penalize their this thing. And here also is an industry where they don't have any investment in this channel.
And there's no skin in the game.
They can just disappear if it comes to it.
Okay. So this was one assumption which failed. What else failed?
One other is you always think that, okay, you become extremely large. And because of that, you will have so many curves of efficiency curves that you'll unlock. And that efficiency curves will also mask some of the disadvantage that you will have in terms of regulatory compliance side with respect to your competition. Example, my competition unlikely to pay a PF ESI, unlikely to pay a GST, unlikely to pay do the right thing when it comes to a lot of things. Whereas we cannot build an institution with these shortcuts. We need to have, and these compliance costs adds up to a few percentage points. While yes, we had factored in that there are these efficiencies that will get unlocked at scale, it did play out, but it got sabotaged by this regulatory arbitrage that the competition had, which eventually meant that we really didn't have a distinctive competitive position in the marketplace when it comes to the cost structure. that you will have this advantage because of which you'll get a disproportionate market share in the marketplace. So those are some of the assumptions that did not play out as initially projected.
Okay, got it. So how did you you raised about $90 million over a 4-month period? Like December 21 you raised 40 million, and then March 22 you raised another 50 million. How did you raise so much money? Like it was the self-belief. You believed in the pitch, and that worked for helping you raise this.
No, I think, see, those were the markets that really, and those were the times where people actually had this belief that if you are able to capture market share, there will be ways to translate that into profit over a long period of time. And the horizon of that period was very long, given that there was a inherent positivity in the market. There was this whole underlying belief that there is going to be access to capital perpetually, right?
Because of zero
And
interest rate.
zero interest rate period, perpetual access to capital. So which meant that when access to capital is very, very high, the growth assets are going to be fewer. So there is going to be a lot of capital chasing the growth assets. And we also were seeing the same tailwinds. We were doubling every quarter, which meant that yes, we were in the right spot and we attracted capital, not from, of course, from some really marquee names. And that's what played out in those 6 months. Now on March 22, when we started looking at, okay, what next? Now we have the GMV. What next? How do we translate this into margins? Right? Here is where we are saying that, yes, I think it was a fairly, I would say, very candid admission that while we got to the scale, translating that into margins may not be as efficient. Also, it's not like a point in time realization, Akshay. It's not that March 2022, one day I just woke up and I realized that doesn't work, right? Start questioning some peripheral segments that you are in first, right? And then say, okay, let's get out of these. Let's focus on this. Now, when you get out of this, then you also question, how do I now grow from here? Then you start looking for segment, which is the international segment. So you open something. Oh, then yeah, it makes sense. It's making more money. Then there is one segment which is making more money. Then you have in this domestic, you see still there are, let's say, 5-6 segments which are not making sense even as you grow. Then you keep stripping one after the other, right? So in a way, the way this evolved was around you keep stacking up on the international side because it made sense, and you keep deleting because it didn't make sense. And what helped in this kind of a ruthless prioritization is also the fact that there is no more capital coming your way. You have to play with what you have. And when you have to play with what you have, you need to be honest about what will work. Right? In a way, I think if there was more capital available to us, maybe we wouldn't have done this rapid pivot or a hard pivot in terms of India to global. You would have still given some more chance the India business. For all you know, it could still be around, but in retrospect, I can say, okay, now I've seen the profit that I'm making in the global market. There's no way I could have done that in the Indian market, right? So it's in a way, it's something positive that worked out, that capital became scarce and we were forced to make some choices to ensure that we have a sustainable business. And that's how the whole thing worked out, right? It's not a point in time that I woke up, decided, saw this thing. Now, when the whole things were buoyant, we were doing well, we were scaling, we were getting market share, we were raising capital. So that's how the $90 million offer happened. The good thing about us was that we realized that we need to change when we had capital in the bank.
Amazing. It's funny how it's constraints that define you rather than the abundance you have access to. It's so funny. Okay. So a lot of things that you speak about, I want to kind of understand the personal story of them. Doubling every quarter sounds, uh, I mean, it sounds phenomenally hard, like the kind of stuff which would burn out a founder maybe. How did you manage that kind of growth of doubling every quarter? And then, shutting down segments, which also can give a lot of stress to founders. How did you manage all of that?
So this is a single founder company, Akshay. There are moments where I have really regretted that I don't have a partner here in this journey. Having said that, I think the mental model that I have of myself is like a soldier. I'm on this journey on my own, and I've taken on this responsibility, and I just need to deliver. Right. And I'm also somebody who doesn't really think a lot about what has happened. I think a lot about what is not in your control. It's something that comes naturally to me. And all of that has really helped me stay sane in these, really hard moments. I think in a 4.5 years, what we have achieved, incredibly proud of in terms of scale, etc. In spite of having shut down, almost we undid 2 years of hard work one fine day, and then we said we'll start afresh. And in spite of that, where we have reached is there. So a lot of this comes from. So the thing that we have built out is definitely the speed, and that speed comes from clarity, right? And personally, I think clarity is something that comes to you because of your relationship with some of the abstract things, right? I'm sure a lot of them speak about the relationship with your body, your customers, your investors. Those are real things, right? I don't need to go into it. They're all important, but I don't need to go into it. But your relationship with the abstract things like your soul, your money, what's your relationship with money? What's your relationship with time? Right? Concept of time. I think some of those help in terms of making some of these hard choices in a very clearer manner where you're not double guessing yourself, right? So coming back to my own principles around some of these abstract things, when it comes to money, right? I fundamentally feel that a superpower of anybody who is in the business of taking risks comes from what some people call as, FU money, right?
Yeah.
Right? And it has two sides to it. One side is that you increase the numerator. The other side is that your denominator is so low that you can say, I don't care. Right?
So
I am
numerator,
the latter.
denominator is how much you spend every year. So like say,
Exactly.
I need 20 lakhs a year to spend, or I
Exactly.
need 50 lakhs a year to spend. So if you reduce 50 to 20 lakhs, then your money can last you longer. So your FU money
Absolutely.
amount needed is smaller. So that's what you're
So
saying.
essentially, that's where I'm saying that as a guy who's in the business of taking risks, if you are able to be a Spartan, right, your ability to take risks
Goes up.
compounds.
Oh yes, so true.
Right? So that's the relationship with money. That is very important, right? Second is,
What was that number for you? The amount you need to survive every year?
see, honestly, I don't even own a car, Akshay, today. That's how basic and minimal I am. And I think today, if you give me a 50,000 rupee a month,
You
I
can
will
survive. Wow, amazing.
Right? That's my superpower.
Amazing. Yeah, that's
I can
phenomenal.
travel in bus, I can travel in train. I can, even today I travel in auto rickshaw. Basically, if I want to go from point A to point B, I don't need a welfare. I can do with anything that is there.
So,
Right? So that I think has allowed me to have a risk profile which allows you to do something that we have done as Captain Fish, right?
Yeah.
Second thing is your own relationship with yourself, right? How do you see yourself? I've always seen myself as a work in progress project, right? Of course, you need to have a very high bar for yourself, but you also need to be okay to let yourself fail and learn and say that whatever is done is done. Let's focus on the future. Basically treating yourself as a project rather than a end state and being true to that, right? And the third thing is, I think, your own relationship with the time as a concept, right? I always think this, that, as time, right? You have a choice to be a cow or a lion. A cow is basically like you have a calendar and you have these things marked out in your calendar, and you are basically going from one block on that calendar to the next block. You are basically grazing, right? You have a piece of land and you graze,
Okay.
right? Or you work like a lion, which is basically you love something. It doesn't matter whether what you do is 10 minutes out of entire week or 1 day out of entire week, and you decide, okay, outside of that, what you do, you pause, but you go for that large outcome moves, right? Which are make or break, but it will help you sustain. So as a company, as a person, I have been somebody who is on the latter side, who was believed in doing these big, high impact, fewer things, which are make or break, high risk stuff, versus setting these cadence and saying, okay, I'll do 10 review meetings in a day. I'll go from one calendar block to next and I'll graze like a cow.
Yeah. Okay.
And that's how I treat my time and effect, right? So some of these personal choices have also helped, or rather played a role, right? Obviously, this is not prescriptive. It's not the same for everybody. It's just my personal style.
Do you work like 70, 80 hours a week? Or is it that when needed, you will work 70, 80 hours a week? As you said, that there are
When
those high
needed, I
impact.
can do anything.
Okay.
When needed, I can do anything. If
But it is
something
not
is
a
exciting,
habit.
it's almost like if you take my last 12, 13 years of professional career, I worked the hardest in the last 3, 4 years, simply because it's an adrenaline rush that keeps me going. It is not because there is a money that is riding. It's not that. It's just that it's just exciting. It's just all raw energy coming to the fore when you're doing what you're doing. Like there is this concept of hard work, right? I don't think you ever question whether or work-life balance. You ever question that, oh, Michael Jordan put 100 hours a week to get to where he did, or Virat Kohli did 100 hours. That's not controversial, right? You expect that that's natural because he's
Yeah.
top of his game. He needs to
Yes.
be there. But I don't know, for some reason, entrepreneurship, work, doing a day-to-day stuff, if you're putting 40, anything north of 40, 50, 60, you're toxic and you're seen as somebody who is twisted, right? But if you love, you do it. And if
Right.
you love and do something, you are off the chart. Right? It plays out in every other aspect of it.
Yeah. That's a good way to look at it. Amazing. Okay. So, coming back to the journey. So, how did you do the global expansion? Like, I mean, you told me in a line that we shut down many India businesses and we started opening many global opportunities. But how did you actually go about finding customers, signing them up, convincing them to buy from an Indian company? I'm sure India doesn't have that same reputational advantage which a Norway has, for example. How did you actually crack your global go to market?
So I took the riskiest path to crack the global market. I went and acquired companies.
Wow. Okay. The advantage of having cash in bank, and also the fact
Absolutely.
that when you are frugal, you can take big risks. So both of these coming together, cash in bank, ability to take big risk, amazing. Okay.
And going all in, right?
Mm, mm, mm.
Going all in, having the clarity that this is the move that will make or break my company. And I am fully convinced that this is the only move. I bet my entire cash in the bank. There was a moment where I was transferring this money that I had to a company that I was buying. And it happened to be where I was on the flight from Chicago to Dubai. And I was entering the password
How much was the
via,
amount?
the amount was $49 million.
Oh wow. Oh wow.
And basically, if I had got that move wrong, like that moment wrong,
Yeah.
that was the end of Captain Fresh.
Right.
Right? So, which is what I said, that we have played it like a lion. Right? Went after 4 or 5 tectonic moves, which redefined the trajectory of Captain Fresh. In hindsight, they have worked out very well. But when we were in the thick of that, there are many other reasons why we were sane, we maintained composure, we said this is the right thing to do, we had clarity, went about it. Right? So to your point, we we basically did the riskiest thing that one can do in expansion. We went and did a bunch of acquisitions, not one, a bunch. And yes, I think today we have landed safely. I can safely say that today we have landed with our feet on the ground. I don't anticipate any turbulence, so to say, fundamental turbulence at the platform level from here on.
Just take me through these 4-5 big shots you took, big swings you took, each of them, like again with the timeline.
So one of the biggest swing that I wanted to take, we were a 25 or a $30 million, maybe a sub $50 million business, like even before the March 2022. When I started thinking about the global expansion, the first company that we wanted to buy had a scale of $950 million
Their annual revenue.
$950 million revenue amongst the top 5 distributors in the US. And I was very clear that we should go after that acquisition. Right. And spent a lot of time. In fact, I spent 1 year. I spent 1 year to go after that company. Initially, it was a hard task for me to convince that we are a credible buyer to the sellers. And like I said, for me, it is one problem at a time, one tough problem at a time, and I give it all. Like I go all in. I convince, then we started raising money to stack up to do that. But that coincided with the market going south in terms of capital raising. So we could not complete that transaction.
Oh, okay.
Right?
Okay.
But in the system, we set the bar at 920 million, 950 million in terms of the size of the swing. After that, we got an asset which was 350 million, which was, for all practical purpose, it was 2-3 times our size still.
Yes.
But the swing was, at least for a lot of stakeholders, a manageable swing.
Right.
That's what happened. And like I said, in a lot of these, it's a most contrarian thing that you could think of. But finally, it comes down to logic, numbers, plan, execution plan, clearly identifying risks, having ability to articulate how we manage those risks, right? And ability to take the stakeholders along in a very genuine, sincere and honest manner in terms of how I am thinking about it, right? How with all my intellect, I believe that this is the right thing to do for Captain Fresh, right? It comes down to all of these small building blocks, which, if you ask me, is no different from a relationship with a employee relationship. How do you build a relationship with anybody? It is a set of small, genuine, sincere conversations, which is backed by rational logic data. That's what I did.
Amazing. What are these assets priced at? Like you, this $950 million company would
Typically, we pay 7, 8, 9 times EBITDA.
Okay.
That's what we used to pay when we were a nobody in this industry. Now we are looking at a mid single digit 5, 6, 7x types.
Okay.
As we are becoming more and more prominent buyer. Hopefully, as we go to the next stage of our life cycle, we hope to streamline that pricing even better.
And what is the EBITDA margin of these distributors? Like say that 950 million?
Typically mid single digit percentages.
Okay. So when you were trying to acquire that business, this was around that, after that March 22 raise of 50 million, you wanted to do one more raise to acquire that.
Correct.
And that because the interest rate turned, so you were not able to raise, and so you went after smaller targets. So
Yeah.
What were those targets? Just talk me through the profile of each one. The 350 million revenue company which you acquired, what did it do? Which area? How did it help you?
So these guys were one of the top brands in the US packaged seafood market. These guys, typically, if you walk into any tier 2, tier 3 retailer in some of the large cities in the Eastern Corridor, you will find a brand in the freezer. Also, these guys were very strong on the food service side. So a casual dining chef or a fine dining chef typically has a choice in terms of what brand of seafood product you would want to buy. So they were amongst the top 3, top 4 brands in their target markets. So what we got into was, like I said, what we buy into are 2 things. One is relationships with the customers, because we believe that as an Indian player, we will not be able to establish that relationship in a short period of time. Second thing that we buy is a reputation or a track record, which hopefully we can leverage that to add more and more products to ensure we get higher wallet share within those relationships. So in case of what we bought in US, there are 4,000 distributors who distribute to the universe of restaurants, not just seafood, but everything around say around the plate, in the plate, everything. And we service close to 1,000 of those 4,000 customers through these brands that we acquired. So that's our strategy in the US, which is largely around going after food service market. In Europe, the strategy is different. There are strategies to go after retail, because the seafood consumption is over-indexed on retail channel in the US. In Europe, where almost 2/3 of seafood gets consumed through retail, versus in US, 2/3 gets consumed through food service. So in the European market, our
Food
strategy
service
has
means
been to
restaurants, right? Like
food service is restaurants.
okay.
And everything else. Food service is out of home, is restaurants, is your institutions, even your jails and schools and hospitals and
Okay.
all of that.
In
Retail
India,
is at
this is
home.
called Horeca, right? That
Yeah, in
hotel
India it's called
restaurant,
Horeca.
catering.
There they refer to it as out of home consumption. Retail is at home, where you take it to your kitchens and cook. So in Europe, at home is the 70% segment. In US, out of home is a 70% segment. So our strategy in Europe has been to
Yeah, but despite everything, I'm really enjoying the conversation. I just love how analytical you are about things. It's amazing. So, you gave me this analysis that, okay, in US, 70% of market is food service. In Europe, 70% of market is retail. Was this something you analyzed before your acquisitions, or you figured out along the way after your acquisitions? Oh, this is how this, like, how did you learn these things?
So I have a method to this madness. when I wanted to expand, I did this 40 city trip to US, where every day I would visit 2 cities. And within each city, I would get to at least 10 different retail stores.
Madness. So just start with that. I like that term of method to the madness.
So in terms of this whole market expansion, the global side, at least to arrive at a mental model, I had a method to this madness. The method was that I used to travel. So US, when I said US, I traveled to 40 cities. And 40 cities, almost 2 cities a day. Every city I would go to at least 10 to 15 different points of consumption, different types of retail, go into their seafood aisle, understand the composition of the shelf, fresh versus frozen, which origin is the product coming from, raw versus value added. And he did that over 40 cities in a matter of almost 1 month.
Wow.
Right. And when I did this, I used to take down all the names of the suppliers and things like that. Right. And in parallel, we had got Bain to do a research for us, which is give me a complete market scan of what's the segment, which are the hotspots, etc. Right. In fact, I think as a startup, we have used these large MBBs very, very generously as a startup. Because for me, if I'm not armed with data and clarity, right, it is just a compulsive disorder. I just cannot go in. And I did the same thing in Europe. I went to 5 cities in Spain, across the cross section. Like if you take Spain, I went to Madrid, Barcelona, Valencia, Seville, Malaga. Right? It's a representation of all tiers of cities. I did the same in Italy. In France, I went to 5 cities. And in each of these, I would go to a wet market, go to a retail setup. So after 2 months, when I reflected on this entire what I have seen, and by that time, even the market research report was ready, which was a top-down analysis, right? Then is the culmination of my strategy in terms of which team I need to have in my global listing and in what sequence. The fact that US should be a food service, Europe should be a retail, and the sequence should be Western Europe, Central Europe, Southern Europe. The fact that these are the brands that I should go after. This is the species that I need to go after. This is the value addition that I need to go after. Like I start with cooking. I will go into a smoking. And then I'll think of portioning or any other form of value addition. Right? So the entire thing was put together top down. And then when the acquisition ideas started coming to me, it was easy for me to decide. Like I say no in 5 minutes because I clearly know what I don't want. So it is that clarity. That's what I said in the beginning also. If there's one thing that differentiates our journey is the speed, and speed is because of clarity.
Amazing. You are a data processing machine. The way you went after that data to seek out that data, irrespective of what it cost you, and it obviously cost you. I mean, you would have probably stayed away from your family.
We spent I think $5-6 million just on market research, honestly. And for a startup of our size, it's a substantial number.
Yes,
and,
it is.
And I don't regret any of that because the kind of clarity and speed that it has given us is the only reason why we are in a span of 4.5 years, not 20th largest player in the world when it comes to seafood.
Wow. There is this popular narrative of the hustle culture and you need to hustle. I think possibly a better narrative is to seek data and seek clarity rather. That's one thing I've learned.
Keep going back to cow versus lion, right? It's not mindless hustle. Yeah. It's about reflecting, thinking, and when it's needed, high intensity, life depends on it kind of a move.
Yeah, you need to be a sprinter instead of looking at it as a marathon run. You need to take sprints when you spot opportunities, basically.
Yeah, that's at least our playbook. I'm sure it's not, everybody has their own way of doing things.
Amazing. You've not spoken much about how you build supply. So all of these acquisitions were essentially distribution channels, right?
Correct.
Ways to get product from India into the Western shelves.
Yeah.
But product from India itself would not be a non-trivial problem, right? That itself
Yeah.
also.
So
So
product
tell me
from
about
India
that.
is not a non-trivial problem. And if there is one part of the equation that I solved in the first 2-3 years of our journey that I could continue to hold on to, it's the supply side. And that itself was a journey, again, not well documented. To give you example, the unlock of how the marine supply chain works in India, the way I learnt about it, like I used to go and sit in these railway stations and then look at the way the products are moving, which station to which station they are moving. So typically, if you take a thermocol box in a railway station that carries fish in the parcel, they have a 3-digit code that tells which station it is going to. That's the code of the station, to station, and a 3-digit code from where it is coming from. And on top of that, there'll be a supplier's code, which is another 3-4-digit code, right? I used to go and sit in these Bangalore and Chennai railway station and mark out all of this. So kind of getting a network graph of how the marine supply chain in India works. So in Bangalore, how many different trains carry this and from which all stations it is loaded, and then start peeling off. Like, for example, from Tamil Nadu, Tuticorin comes. Tuticorin I see as a higher frequency repeating thing. Then I would go back to Tuticorin. And then in Tuticorin, do the same exercise. Then go back to the supplier. So that's the exercise that it did over 3-4 months. Now, the point I'm making here is ability to learn about the supply chain in a first principle way was important for me as an organization. Otherwise, the other method would have been that I will get somebody from the industry and rely on their knowledge base and rely on their sharpness of their insight to be able to devise my supply side strategy, which I was not comfortable with. I wanted a truly comprehensive way to be able to say there's nothing outside of what Captain Fresh knows about seafood in this market. Once I learned this, I put 20 people on the job almost to be able to do this across all permutation combination of railway stations, suppliers, mapping out, yes, this is how the flow of seafood happens from the source to the market, right? So that gave me a method to this madness. And you won't believe we have done this in Madrid. We have done this in Barcelona. As we speak, we are doing this in markets like Fulton in New York, where teams sit there and do this mapping in terms of how does this supply chain unravel on the back end, right? So this, we mapped the entire stakeholder set. This is just one example of how we've gone about it. Just to give you a sense of how unorganized this is. There's nothing, no research in this industry, right? There's nobody who's going to come and teach you how this works. But after that, yes, the two things that have worked, one is obviously the India playbook that we did. Second is my own experience as a exporter, being part of Neck and Tea, seeing those operations. So this whole beast as an factory operator and an exporter is something that I learned by being part of that company. So put the 1 and 2 together, which is farmers, fishermen, sources, data gathering, plus how a factory works. That's how I put the supply side game together. And supply side is all organic. We don't do any acquisitions on the supply side. It's all organic. So this is how I stitched together the tropical landscape. So I did travel to Vietnam and Indonesia. So I have lived almost 200, on an average 200 to 250 days in a year on road over the last 4.5-5 years.
Wow.
On an average. So today, if I am a leader in seafood, understanding how these global corridors intersect and operate, It is because of the brute force of me having seen all of these notes with my own eyes and reflected upon why some things are structured the way they are.
Fascinating. So, from what I understand, you are getting supply from India, selling to the West. That why are you mapping in other countries? Like, why are you mapping in Spain?
No, by the way, supply from India is just 25% of our supply. Today, we are a truly global supply, global demand. We also source
Okay.
from North Atlantic, like the likes of Norway, likes of Faroe Islands, likes of Denmark. So this has unraveled on both sides, both supply and demand. It's unraveled into a global platform.
Okay. Okay. What was the reason for that? Just to increase the top line. You need to be able to supply more.
See, one of the things that I learned when I was doing this whole roadshow for one of the companies that I was listing is that the biggest downside of operating in fish and seafood industry is the predictability of cash flows. And that predictability of cash flows is a problem simply because you're operating in an act of God category. So the moment, for you, the surface area is the surface of the earth. As much as you're spread out on the surface of earth, you increase your luck in terms of being predictable. If you constrain yourself to a certain corner of the world, let's say Indian coast or west coast of India, your luck or bad luck amplifies to that extent.
Amazing. Do you have more time? Okay. So, early on in the conversation, you spoke of the fact that in investment banking, you did not feel like it was a compounding choice. I want to kind of understand what you mean by a compounding choice, how that principle has played out at Captain Fresh.
See, when I say compounding, there is one compounding in terms of you have learned certain skill, you have gathered certain knowledge, and then you have built something basis that, and that what you built is creating value for you over and over, right? In investment banking,
the marginal cost goes
instead.
down. Like say, if you're a SaaS company, you build a good software.
Good
Every
software, so it
additional
keeps
license,
compounding, right?
every additional license costs you $0 basically.
$0, but you keep adding value.
You keep earning
Anything
more
that
revenue,
you build actually adds value, right? Whether it's software, whether it's business model, business process, anything. Whereas in business, in investment banking, what I saw was you're as good as a deal that you are part of, and when you start the next deal, yes, of course, you have your talent. Basically, it's yourself which you have invested in. You are a better banker, but you're actually as good as the next deal that you can execute, right? The second part of this compounding is the operating leverage, right? The only operating leverage you have as a banker is your time,
right?
Your own time, right? Whereas here, you have 100, 200, 500 people's time operating on your vision, and that compounding you have a share of, right? So that's the thing that I thought that if you're on this whole intellect ladder, you are anyway at the top of the thing when it is investing or banking or any of these idea-based businesses. But if you add leverage to it and the element of building to it, maybe you can create more value.
Okay, understood. Have you used this principle at Captain Fresh in terms of doing things which have a compounding effect?
Absolutely. I think we think about it all the time in terms of what are the things that compound for us. Obviously, anything that is any investment in tech, any investment in doing something which we are very different compared to the existing player in the market, or anything with respect to training a certain set of people, right? Anything that adds to a competency set.
Okay.
As much non-linear as possible. That's like a wish list. Linear is good, but if non-linear, then even better. We would love to, but honestly, it takes time to discover all of this and put these pieces together. But I think we have a fair share of these compounding elements in Captain Fresh, which is what makes it unique.
What is the headcount of Captain Fresh?
We are around 340 or 350 people.
That is amazingly lean. And what revenue do you expect to do current financial year?
Current, we should be around, we are at a run rate around 640, 650 million, but we aspire
So,
to be around $1 billion in the next
wow.
3 to 3 quarters.
So you are doing like $2 million of revenue per headcount. That is phenomenal.
That's something that I truly look at, honestly. And I think in the AI induced era, that number should be at least 3 to 4 times that where we are.
How do you do that? I've hardly heard of companies doing $2 million of revenue per headcount. Like, that's phenomenal.
I think it's a ruthless thought process which is around, should I be the guy doing this? Is there anybody else who can do equally better or better than us? If the answer for the latter is yes, then let me not do it.
Give me an example.
Like, for example, factory production, right? Today in the market, there are many players who do production. Like, there is a B2C player who does their own production, right? There are a bunch of circle. But we said, no, we are not the best in doing production. We are the best in laying out the SOP for production, right? I don't want to optimize anything fancy in terms of my metrics. If I have to let go that margin, I'm okay to let go of that margin. I don't want to showcase that margin to net off all the costs and finally arrive at the same net margin.
Okay.
Right? Being ruthless about it. No, I don't want to do it. This is my value addition. My value addition is I am like the HL of this industry or a Britannia of this industry. I will define and I will deliver the demand that is needed. I will create a tech which will ensure that they're delivering consistent, high quality product to us where we can monitor on a real time basis. But I shouldn't do this if it's not worth our time. Simply because I can add headcount to my company, I don't want to handle all of this process, which can be handled by other stakeholders equally competent, in an equally competent manner.
If you had raised more money, would you still have been as ruthless? Like, so what you're saying is you don't operate any factories. All your processing is third-party vendors, but you
It is a
control
very,
the
very,
quality.
I would say, interesting question, Akshay. I honestly think that if the 2021, 2022 bull run had continued, the natural state was to arrive at where I am today. But that was a state where you are playing for the gallery and you would have continued to play without really, going after your natural instincts. Not having capital allowed me to express my natural self, saying that cut all the bullshit out. Let's do what.
Amazing. How do you manage people? I mean, you come across as so analytical in every decision. I'm wondering how you are as a boss. Would my conversation with you as a boss be all about numbers? How would you how are you as a boss to work with? How do you inspire your team?
See, I think, which is why I also want to have fewer people around me. I'm not a people's guy, Akshay. Right? I'm not a guy who can get on a stage and inspire a people with a battle cry. Right? I can't use any flowery language like we are doing a revolution and all that nonsense. Right? So I am a very, very practical, numbers-oriented, simple guy. So I can't really mobilize a mass for a movement. Right? Which is why I'm designed the way I am. I have 24 direct reportees. I have a very flat organization. I have a team that has only maybe 2 levels below that. Very shallow in terms of depth from a org structure standpoint. And I am able to at least directly interact, and I'm very good when it comes to one-on-one communication, because finally it is about rational conversations, logical conversations. And that's what I have relied on. And I also tend to attract similar type of people who don't like too much of nonsense, no politics, no bureaucracy. It's just business, and people who enjoy that kind of a setting. That's how I am managed, with my own set of limitations of being super rational, analytical, and you know, having, you know, having to motivate people through the corners and cycles that we have gone through.
Yeah. How do you manage 20-25 people? Is this a factor of very, very selective hiring, and therefore whomsoever you hire, you have blind trust on them, or like?
Yes, that is true. I am very, very selective in hiring. And when you are doing only these many hires, like I hire 1 or 2 people a year at this rate
Wow.
of growth, right?
Mm.
I end up spending a lot of time pre-hire. Second is, I also think that the paradigm of managing relationships has changed thanks to asynchronous communication, WhatsApp led, right? Sort of rules that, the org design rules that were previously written in the previous era, right? Synchronous communication and things like that are not very valid. I fundamentally believe that a flatter organizations are the tool for speed. And with today's paradigm, technology, communication setting, it's more a norm than an exception. You can do it. It's not necessary that you need to have too many layers and too much of concentration of power under you and all of that.
Amazing. Let me end with this question. What's your advice to the listeners who aspire to be founders?
It's a, of course, there's many aspects to this. But I think having a very large purpose is extremely important. Don't become a founder because you want to become a founder. Have a purpose or have a mission or have a problem statement, and let that excite you to become a founder, because you can only fake it to certain extent. Finally, the reality and that authenticity of building something comes from that, what you are solving for, the purpose that you're going after, which lets you wake up every day. And even in those moments where you feel that you're dripping in blood and you're there getting punched in the ring, right? You still think that you're loving it, right? It's life and you love it. That is basically coming from the power of purpose that you're chasing and the problem that is exciting you. If that is not the case, if you're becoming a founder for the glory or glamour and all of the nice things that are there, you may not sustain the punches.
So I want to kind of point something out here. I think you became a founder because you saw the TAM here, right?
I agree with you. Yeah.
So, like, once you became a founder, then you discovered the purpose and found the passion.
So purpose is the impact. Honestly, TAM is the
Okay.
impact. See, essentially, for a middle class boy like me, to be able to deliver or do something which is impactful, which is creating so many jobs, which is doing something, right? That's the impact and that's the purpose. And obviously, analytical way to arrive at that is TAM.
Right. Okay.
Right.
Hmm.
But
TAM is a symptom of purpose in a way.
yeah,
Like it's an
a
expression
symptom.
of.
But the fact is that for a guy who comes from a family who had no clue about business, for me, this is something that I can never lose. I will do everything to protect this thing, because I feel this is a once in a lifetime privilege that I've got. And that is impact, that is legacy, right? You should have 1 or 2 of those drivers that is beyond the short-term things.
When are you likely to do your unicorn round?
No, I don't think we'll do an unicorn round, and it's natural. It's also a responsibility, right? Like, actually, I'm almost gone to a point where being a unicorn is a massive responsibility. Questioning yourself that, okay, are you really there? For all you know, it may happen in the public market where it's a natural discovery of valuation rather than you calling yourself a unicorn. It's just you have delivered a set of cash flows, which a wider set of brains decide that the valuation is that.
I just want to say that I recorded an episode with Utham exactly a year ago. I checked in my calendar. It was in January last year that we recorded originally. So we couldn't release the episode at that time. There was an IPO which was on the cards, and your legal team advised against the release. But now we are going to release that episode, and it only makes sense to update that conversation with what's happened in the last 1 year since we spoke, and if there were missed opportunities in that conversation. Although I like really enjoyed the conversation when I reheard it today. Uh, Uttam, first give me an overview. Like, what's the and before we actually get on to the business part of it, I just want to say that you are looking much leaner than when we recorded a year back. I'm sure the audience members will also see that. What was that, like your resolution of the year or something like that?
No, it wasn't the resolution of the year. Thanks so much, Akshay, by the way. Super happy to be part of this conversation again. So coming back to your question on the fitness, not necessarily part of a resolution or something. I would say it's slightly a little bit more broader. There was a point in time. So I'll tell you a bit, right? Like in terms of my travel, I was just doing the numbers yesterday. I have traveled 1.8 million kilometers in the last 3 years. And 1.8 million kilometers kind of ranks right up there. Like Elon Musk has done 750 kilometers a year, 750K kilometers a year. And a typical Fortune 500 CEO does 2,500, 2,500, to 250,000 kilometers a year. So I'm like 3 times.
Wow.
And early this year, doctor advised that, look, if you continue to do the same, you're putting your body at massive amount of risk. I barely remember the number of nights I had slept for like continuous 5 hours because of really horrible circadian rhythm. So it all kind of came together that, look, we are on a journey, which I think I'm really enjoying. But this entire journey, the only vehicle that we all have is our bodies. And somewhere, it was a culmination of all of those parts, where my cholesterol, my everything was off the chart, and I really had to fix things. And I thought, then if we fix, then let me go to the end of it, like really get to the best version of myself, which is 10-11% body fat with six pack and with lean muscle mass and all of that. So that journey started like 2 years ago, 2.5, 3 years ago, I would say. I was weighing 94. Now I weigh 63. I
Wow.
was at 40% body fat. Now I'm at 14.5, 15. But I think the best part is I sleep 8 hours easily, which I had never done. Like my average sleep score for the year is close to around 90, which is unbelievable. And my sleeping heart rate is like 47, 48 with a HRV of 65, 70. So I kind of rank in the top 1% male for my age group with
Wow.
respect to all these biomarkers.
Hmm.
So it's amazing how, just a 6 month or a 1 year effort in terms of everything, nutrition, recovery, everything can really fix the body to this extent. It's amazing how powerful your body is.
Incredible. That is so inspiring. Okay, give me these kind of. So you just gave me some stats like 14.5% body fat, and you have how many hours of sleep, etc. Give me similar stats for the health of Captain Fresh.
Captain Fresh, see, I think I couldn't have been more pleased with how far we have come. We clocked around 3,500 crores of revenue last financial year. This financial year, we are on our way to clock close to around five and a half fish thousand crores of revenues. We have already clocked close to 2,500 in the first half. We delivered an EBITDA of 125 crores last year. That I think is going to be anywhere between 2.5 to 3 times, close to 2.5 to 3 times in this financial year, FY26. But more importantly, if you look at our run rate revenues for the coming quarter, uh, we should be north of 10,000 crores.
Wow.
So next year, FY27, we're looking at close to 10,000. So if you look at the trajectory, FY24, we did 1,300, FY25, 3,500, FY26, 5,000, FY27, 10,000 touchwood. And if you look at the EBITDA trajectory, obviously we're making like a couple of hundred crores losses in FY24. We turned profitable in FY25 with 125 crores. And this year, like I said, we should be anywhere between 300 to 350. And next year, we should be anywhere between 700 to 750. So it's something that not many people know in terms of how large the business has become. It's when I sit back and see we're now a beast of a global packaged food company where we sell in our own brand. We have a market leadership position in pretty much all the channels that we operate with. We are turning out to be a very strong luxury protein platform focused on the US and Europe, closer to north of $1 billion in terms of our size. So that's how far we have come as a company. It's Captain Fresh. So yeah, that's broadly the health of the company. I think the one other thing is not many startups talk about return on capital employed. So we have delivered, I think, 8-9% in FY25 and FY26. We are in a range of 20% return on capital employed, and we should be at around 27-28% in FY27. So yeah, I think that's something that I'm super proud of. That in a matter of 6-7 years, you could create a platform of this size, scale, and profitability.
What does that mean? Return on capital employed? Like, if you've raised 100 crores and you are making a profit of 20 crores, so that's return on capital employed. Very simplistically.
Very simplistically, it's not about the raise. If I deployed 100 crores of capital in the business, I'm making 20 crores of return. So which means that the moment your return on capital employed is more than, let's say, 12-13%, which is by and large, that's the opportunity cost of most of the investors. If you are in the range of 20-25%, it only means that it's easy for you to get access to capital, theoretically. Because your return on capital employed is by far higher than the opportunity cost of most investors that you come across.
So what's behind this 10,000 crore run rate? 10,000 crore means like more than $1 billion of run rate. What's behind this? Because you did tell me how you started shutting down the India business. It was a very hard market. Is this all on the back of acquisitions?
Yes and no. Acquisition has played a role. So I think stepping back, if you look at the industry is a $600 billion industry. But where the opportunity lies is there is $1 trillion kind of balance sheet this industry carries. Like if you take all the players in this industry and add up all their assets, current assets, everything, it's north of $1 trillion. But the opportunity is that it's extremely fragmented. It's like across like millions of companies. Like the largest company is just 1% of the market. So that's the opportunity. Now, in that opportunity, if you see similar such industries where other tech first players have really gone after and disrupted, you will see that whether you take an Amazon or an Uber or a Airbnb, let me take Uber as an example. Right? They have basically taken a similar $1 trillion balance sheet, which is like these small car owners across the world, and brought them onto a platform, and then really funded their customer acquisition pipe for almost, I would say, 25-30 years from equity. And then over a period of time, that has created a platform which is supply and demand connected. So they invested in digital tools and customer acquisition. So similarly, there is DoorDash. There's all of this, right? The DoorDash is for restaurants, billion or trillions of restaurant investments. Similarly, Airbnb is for these houses, trillions of them across the world that gather. So if you see, our playbook is not very distant from that playbook. The only difference is that in our case, we chose for customer acquisition part, we chose inorganic. Only reason is that we are operating in a B2B environment, and in a B2B environment, especially in the US and Europe, reputation is a massive currency that you need to have, and it only builds over a period of time. So if we choose to build reputation organically, it is going to take a lot of time, and I'm not even sure if it is economically very efficient. Right? Basically, what I'm saying is, if I organically build this business today, is it going to be cheaper than me acquiring the business? That's a question mark. Including the execution risk, my conclusion is that it is not, which is why we went out and acquired these customers. So today what we have is around 1,500 very high quality premium customers in US, which we acquired. And when we acquired, the wallet share of those customers were less than 1%. So the opportunity for a platform like us, given that we have really scaled up our supply in a very asset-light manner, is to be able to cross-sell different products into those relationships. That is the growth that is playing out. So if you see FY25, FY26, FY27, yes, we continue to acquire new customers through acquisition. But the ones that we have acquired already, we continue to deliver higher revenues per account. Now, everything that we deliver for the same account almost comes at zero incremental costs as far as my distribution is concerned, because the biggest cost that I have is sales guy, and the sales cost is per account, and it's the same cost that works for you. And the only thing that we have managed to do is essentially bring in technology to be able to help the sales folks manage the cognitive load of managing a plethora of SKUs. Otherwise, each species that we introduce into the platform is around 500, 600 SKUs. So you can think of the cognitive load that the sales guy has if there is no technology player. That's our value addition, which means that we have reduced the friction of sales for these sales folks to sell their product into the accounts that they've been working with for like 15, 20, 25 years. So that's what we've done. So that is what is playing out in this growth. So I would say in the incremental revenues in between FY25, FY26, FY27, FY25 to FY26, it's 80% organic. But FY26 to FY27, there is a decent amount of inorganic because we did one more spurt of acquisition, which as we are in the process of closing those acquisitions in this quarter, which is why this 5,000 to 10,000 crore jump, I would say almost 4,000 is inorganic. Hopefully FY28, where we don't plan to do any inorganic, this base will work for us to keep increasing that revenue.
Okay, so I'm going to summarize my understanding. Essentially, you're building the pipes for seafood trade globally, and one part of the pipe is supply, the other part is demand or getting access to customers. So what you're saying is that to organically go and build the demand side is not worth it. It is much cheaper, faster, better to just acquire existing companies which have relationships with customers. And then since you have that pipe going to that customer, in that pipe you can send more species. Maybe that company you acquired was only selling tuna or whatever, XYZ shrimp, something like that. Now they can also sell tuna plus shrimp plus salmon plus basa plus whatever other species. Therefore, it is overall a value accretive acquisition, because that company now has a much bigger portfolio of products to sell, and those relationships are getting leveraged better as a result of being under the Captain Fresh umbrella.
Absolutely. So I'll give you two more data points there. One is the company that we acquired, one of the first acquisitions. We have managed to triple their EBITDA in a matter of 24 months. And these are not on small base. Now, when we acquired, the EBITDA was like $13-14 million. It's on that base we are talking about. And that has happened because we have managed to grow that revenue from 350 million when we acquired to today, I think around 480-500 million in a matter of 6 or 8 quarters. And this growth, the incremental gross margin, has not costed much for us. So essentially, whatever incremental has also flown through to the EBITDA. The second thing is that in terms of the supply side, we had actually used our first 2 years of existence to create these digital pipes on the supply side, right? While on the front end, it's more physical pipes. That's the hard relationships that we are acquiring. On the back end, it's more the digital pipe that we had created. And very interestingly, one unique thing that we did was we created these pipes trying to work with the cheapest species in the world. Most of the volume that we were playing with or experimenting with while creating these digital pipes, it could be Fishgram, it could be FAS, all of these tools that we created. We had Rohu, Katla, Tilapia, Basa. These are all sub 80-100 rupee species. That allowed us to experiment and iterate and really create that. But when we acquired distribution, we went out and acquired the most premium of distributions. Like in the US, for example, we are very strong in luxury protein segment. We have our pipes going into the topmost Michelin star restaurants and fine dining and casual dining restaurants. And there we are selling crustaceans, which, if you see the crustaceans, they are like the king of any luxury fine
crustaceans
dining.
like lobster, crab, these kinds.
Crab, XXL, XXL shrimps, which is like really large, juicy shrimps. Then crabs, then lobsters, right? So that's the distribution that we acquired. And because you're already at the top end, it is allowing us to really cross-sell different products into that distribution. Similarly, we acquired smoked salmon, which is again at the higher end of the protein stack on the retail side. Now we are doing a couple of acquisitions, which is one on very high-end tuna, very premium tuna, which uses a similar stack, access to the premium customers. So what we did is now we are able to sweat the supply side pipes, the digital pipes that we had created on the back of a very premium product, which is going into top end of the market. That is allowing us to really scale faster on the front end.
So these acquisitions would also give you supply side synergies, right? Like if you are acquiring a company which is selling smoked salmon, then obviously it has built that supply chain of sourcing salmon, of smoking it through a plant in a plant or something, packaging it, and now that product can be distributed through all the acquisitions or all the portfolio companies.
Yes. Supply side is definitely a synergies. In fact, the way I look at it is acquisitions are my path to get relationships, whether it's the customers or it's the sourcing side partners. What Captain Fresh brings to the table is a digital wrapper around these relationships on the front end with the customers or with the back end with the suppliers. And what these digital wrappers will do, essentially provide non-linearity for scaling. When we were doing one product to 10 products to 50 products, it just happens with lowest amount of friction on the front end. And on the back end, if I want to go deeper into the operations and start looking at how do I unlock more value out of every ton of product that I move, again, the same digital wrapper will help me go deeper into the supply side. So that's the way I look at doing this in terms of going after existing relationships, because this is an industry which is a low trust industry for natural reasons, because the industry is so complex. The stakeholders generally have a very low trust. So for a insurgent like me to go and disrupt an industry, I can't do it entirely afresh. I need an existing base of relationships and then build on top of it. I feel that that's a smarter route than thinking and assuming that I will do everything afresh. And some of them have tried and failed in our space as well, which is why almost in this whole global fish and seafood new age company space, we almost are like the last man standing today.
Why are you the last man standing? What happened to the other companies?
So there were a couple of other large similar companies. In fact, they had raised more capital, largely from Indonesia, that had come out. But they had tried. One is, I think, one of them collapsed under the weight of misgovernance from the founder's side. But that misgovernance also had seeds in the strategy that he had followed, which is completely organic, which is a very high friction path, right? And which means that initially it looks very, very promising, but as you scale, the friction only compounds. But the assumption is that as you scale, the friction comes down, which is not the case. And now that is what led to that founder along the misgovernance path. That's my read of it. So it was almost like $1.5 billion, I think, in terms of market cap, having raised $400-500 million. Now I think they are almost like a write-off situation to now. So they seem like the most credible competition to us at a global scale. There are a couple of others similarly. There is one called Roozer in Europe, which also got kind of shut down. They were invested by Google and Access. Similarly, they also tried everything organic. So if you look at various geography, I think Europe had a couple of them, Asia like we, and a couple of them in Indonesia. Most of them are really not at the scale and health that we are at.
So I see the logic for the organic path. Now you're saying that you are digitizing the supply chain. It would be very hard to digitize supply chain when you acquire a legacy business, because they may have legacy software. So that whole change management process, both in terms of the technology, the people receptiveness, or changing people's behavior to adopt new technology, etc., etc., all of that sounds like its own battle.
Actually, interestingly, it is not that complex as it sounds, Akshay, because of the way this industry is wired. This industry is, to begin with, is very low tech, which means there isn't much of change management that we go after. And most of the pieces that we acquire, particularly on the demand side, is essentially people. That's truly the competency set that we get, and their relationships. It is not necessarily a very operations heavy business that we acquire, right? It's not like I need to integrate trucks operations and warehousing operation. No, none of that. So because of this, we in fact today are quite successful in bringing all of these companies onto our platform on day -1. Like during the process of acquisition, we end up working with a lot of these folks to bring them onto a platform. In fact, the day they come onto a platform is like the days ago when we sign the deal, wire the money, and move to next stage. So what we have done in Captain Fresh today is, I think we must have done 8 to 10 deals so far. That is now a cookie cutter process. I have a team, whether it's legal, HR, systems, data, like our data team start taking the supplier master, customer master, SKU master, start streamlining into the master that can start talking to us. So it's like completely automated, templatized setup in terms of how we go about doing this. And now I think slowly we are baking that into the screening process itself, that we screen the companies for pursuing acquisition, which also kind of fit well into the Captain Fresh platform a lot more seamlessly than where we were. See, I think if you look at the platforms like what we are building, we are not really new to this kind of an idea. There are several such large companies that have created, massive amount of value building something like this. There is a company called Danaher, which in fact, at least we are following the theme that it is seafood and it's only front end and it's only US, Europe. They are a very diversified setup. I think their business is built only across this competency of buying a company and fitting it in, right? They have something called TBS, which is Danaher Business System, which is a proprietary engine that is there, I would say, core of if they are today a $30 billion kind of market cap company. Why? Because their DBS works. And that DBS is essentially like a management consulting arm, which is doing a HR, a legal, everything, goes into a situation, verifies the effectiveness, comes back, takes on the next project, right? Like that, you'll have plenty. Like you won't believe Accenture has done 200 plus acquisitions. Accenture is a powerhouse of roll-up driven play. A Glencore, which is on the mineral side. So if you see a playbook where there's a cross-sell at the center of it, right? You will see roll-up as like a Glencore, for example. You have a iron ore, you have a coal, you can imagine a similar seafood type of a N cross N matching with customer relationship as a bottleneck. Right? These kind of things lend themselves for a acquisitive play, and the companies that are successful end up codifying the overall M&A playbook, templatizing it so that incremental risks are lower. Like we are already at that point. Like any acquisition that we today are pursuing, the incremental acquisition is less than maybe 10% of our revenues at a platform level. And that 10% is only going to go down. I think by the end of FY27, I think we will be at like 2-3% every incremental acquisition, or maybe 5%. Right? So which means the incremental risk that M&A brings is going to drop drastically, and our ability to digest and absorb that also improves with every acquisition. So it's a very thoughtful, intent-driven playbook. It is not a one-off where we kind of merge two beasts and then we are taking a risk of how the M&A synergies, integration, all of that cultural piece plays out. No, we are not. We are actually a platform with that at the core of it, and obviously the supply side which fits into it.
So a little bit off topic, but staying on the M&A, like amenability to M&A, why did the Thrasio model fail? Like I believe Thrasio is this e-commerce roll-up. They acquire.
Yeah, I'm not an expert in. I'm not an expert in that Thrasio model, but I'll tell you as a banker why M&As fail. M&As fail largely because of three reasons. One, you misprice it when you enter. Actually,
which
that
means
is
you overpay.
overpay. That is
Okay.
80% of the problem in my view. And when do you overpay? You overpay when you are having massive amount of competition for that deal. Right. Second, you have a wrong capital structure or you go over aggressive. So one is you overpay. Second, you back it up with a very, very romantic business plan, romantic synergy case, and an aggressive capital structure to go after.
Aggressive capital structure would mean you take on debt to fund.
Absolutely.
And that
You
debt
take on debt.
then comes with
Right.
interest payments and okay.
Absolutely.
Hmm.
Third, you think you're the hero in terms of saying that I will run this business better than the current set of guys. So I will do the
Right.
management change
Right.
and I will deliver now multiple times revenue, multiple times EBITDA. Right? Like a founder or a guy who is buying a company's God complex sets in when he was aggressive on all three dimensions. He pays a higher multiple. Basically, he wants to be the guy who walks into the most competitive deal and say, look, I'm the dude, I won the deal. Second, I back it up with like 70% debt and 30% equity. Third, I feel I am the hero. I can run this business smarter than the guys who have done it for 10, 15, 20 years. I'll come in and change everything. As a banker, I feel if M&As have failed, it by and large falls into one of these three buckets. Maybe Thrasio did all three of them.
How did you avoid these three sins?
We do none of it. We do none of it.
How do you avoid overpaying?
We only do deals where there is no competition.
Okay.
We have
no competition means there's no pressure to overpay.
We take almost 18 months to close a deal. That should give an indication that it's almost an unbanked, uncompeted space, which also is an advantage because there's nobody like us.
So you do deals with no competition because you have people who are good at hunting out and doing cold outreach?
No. The incumbents are not structured to do a playbook like us. There are by and large two types of incumbents. There are 5 or 6 very healthy companies which access to very, very strong cash flows. But they are in a space where their shareholders are used to taking dividend out. And they're focused on one species and fully vertically integrated. So to make a case today after 30 years of existence that look, I'll now be a multi-species, I'll do all of these acquisitions, etc., etc., etc. They may have to do it, but today I don't see them changing their strategy.
What are some of these incumbents? Can you give me some names?
Movi, Leroy, Salmar. These are all mostly Scandinavian.
Which countries are they from?
Mostly Norway.
Okay. So these would be like the salmon guys from Norway. Or there might be some Japanese guys also here in seafood.
The second bucket is Japanese. Again, they kind of fall into the similar bucket. But I think between the Norwegians and Japanese are relatively more acquisitive. But I think we can outcompete them on speed. There are many places where people prefer us over Japanese. Thanks to their structure, they're very slow in their deal making, and that plays to our advantage. The second large bucket is largely the family managed businesses. The biggest handicap of this industry is the industry doesn't know how to raise equity capital, which comes to the second part. If you don't know how to raise equity capital, then you are funding it by debt, which are essentially you are having a much higher risk that you're playing for. Right?
You have funded through equity 100%, or have you taken debt?
All our acquisitions has been funded through equity.
But you've not
like I said,
raised...
I pay very, very competitively.
Hmm.
100% is equity financed.
Hmm.
Third is where we have really done well. Zero management change. In fact, I have got the management to reinvest in Captain Fish. So that
when
our
you're paying
interest,
them, you're getting them to buy into Captain Fresh equity.
absolutely. That has been
Wow.
the deal that we have done.
Okay, amazing.
So, yes, it seems like I have gone around buying companies, but truth is, I have gone around selling Captain Fresh stock.
Okay,
That's
okay.
really that's where all my effort goes in. If there is fundamentally such a massive overperformance, Captain Fresh, which now you're seeing people realize, it's because I have not bought them. I have sold our vision to them. They have reinvested in our vision.
So these 10 odd acquisitions you've done, what has been the total value of all 10 combined?
I think we would have paid like 120, $130 million, out of which around 65-70% is cash and balance is equity swap. And cash is 100% equity funded.
So about 174. So roughly it's like sub 20 million average deal, like the value of
No,
each
you can't
company.
say that because one deal was fairly large, the first one, because we wanted the
What was
base.
that? How big? What was the worth of
That
that
was
company?
a $75 million equity deal where
Okay.
15 odd was equity swap and balance was cash.
Okay. Okay. So, okay. I mean, you've not raised as much money as like 175 million. So this you're able to do because you're giving them equity. So it's not about how much you have raised because you're
Yeah.
not
So
giving
that
so
way
much
we have
cash down.
raised that thing around 200 million cash.
Of which a large part, or not large part, but some part of it would have been spent in the India strategy, which you originally started with.
Yeah, we did that experimentation, all of that. So I think clearly, let's say in FY27 or we are, let's say, around 50 million EBITDA business or 60 million EBITDA business. I don't think you have any other startup example where they raised $200 million capital and in a position to deliver a 50 million EBITDA.
Yeah.
As in, there are 38 companies or 35 startups that are listed in the stock exchange. I don't think there is any example of this order.
Yeah. Phenomenal. Amazing. Okay. So, okay, I understood how you are making the M&As work. I want to understand what exactly is this technology platform which they are adopting? Is it like an ERP? What is it that these companies adopt?
So on the demand side, like I said, we have basically acquiring the relationship, which is customer who knows our sales guys. And every species that we bring on board has 500 to 600 SKUs. Imagine you are on a call with the customer and then you have now inventory of 10,000 SKUs. And as a sales guy, one is you have not done these 5,000 odd SKUs. You don't understand the nuances of it, but you're pitching to the customer. So what we have done is a tool. It's like a sales cockpit. It's almost like I almost say that we are trying to give a Ferrari to our drivers with all the sophisticated, levers, which gives them a very nuanced view of what their customer wants. And then, of course, armed with very high quality supply and inventory. That's like I would say, the hygiene of this platform. So that's one layer, which is on the.
So that would show them, for example, all the SKUs, what is the delivery time for each SKU?
It is a recommendation engine, actually. It tells them that what they need to pitch to the customer.
Okay.
So we have like dumbed it down, saying that you just need to pitch this, and it's only obviously improving over time with more data, etc., etc. Similarly, on the back end, we have built a factory digitization tool, which today can go into a factory and look at profitability at a batch of raw material level. Now, what this enables us to do is enables us to access this factory bandwidth, which is, let's say, they do 5 or 6 activities. It could be freezing or cooking or whatever that is, right? Now, there is a capital investment that is needed to do this. Now, if I have to share that capacity with me, I should be able to say, oh, look, I brought this material. I used it for so and so time. And this is the output that I've got. And I'll pay you for so and so time. Right? So I have variabilized the capacity. And to be able to do that, I should be able to track at a unit level, the economics at a unit level. And that unit in the supply side is raw material batch. What is that raw material batch? One raw material batch is typically, let's say, if I talk about shrimp, it is one farm getting harvested and the entire batch coming to a factory for processing.
And these are all third-party factories. You don't own any factories, right?
Third-party factories, I don't own anything. So which means that now I have the front-end demand. I can go to these factories and suck the excess capacities and deliver my tech and my raw material and say that, look, I will track the economics as per what I'm giving you and I'll pay you transparently. So that way I can dip into the manufacturing side of the margins without owning the factory. And because it is a species agnostic play, and also it's not region agnostic or language agnostic, I can do this in India, I can do this in Vietnam, I can do this in Indonesia, I can do this in Philippines, I do this in Denmark, I do this in Europe. Right? So the whole world supply becomes your, top of the funnel. So you have the demand. Now you have the ability to get into the manufacturing side of the demand. So right? That's the second. Yeah, good.
These companies you're buying don't have any factories. These are all like trading
these are
businesses.
All just customer relationships. That's what you're buying. In Europe, you have some processing because Europe market is slightly different. Europe does almost 70-80% of what Europe consumes is in the ready to eat, ready to cook. So we need some last mile value addition in Europe. So we have a factory in Paris, in Poland. Now we're buying something in Barcelona. We have something in Denmark. So this helps us in last mile value addition. But the input to them comes from a LATAM or a Asia, which is similar to what I was describing previously, which is the input to US and Europe similar, just that Europe, there is one more leg of value addition before it goes to the customer.
Okay, got it. Your sourcing originally was largely India, right? Like the initial. So what is the sourcing now? What's the split? Like how much of it do you source from India? And
I think India is now around 10%.
Okay, so 90% of what you source is outside.
Yeah, I think second largest could be Norway.
Okay, for salmon.
And then we have for salmon, and then we have Vietnam and Indonesia and Mexico and Ecuador. These are our top 6 countries. I think we source around around $850 to $950 million worth of products, where, like I said, 80% of this will come from these 6 countries. Which in a way, I have Indian Ocean, which is India, Indonesia, Vietnam, Atlantic Ocean, which is Norway and Poland, and Pacific Ocean, which is Ecuador and Mexico. That's roughly how we have our tentacles today in these. But I think the key is that today, for example, from Mexico, I source a tuna largely. So there is opportunity for me to expand other species there. Similarly, India is a shrimp play. There is more that I can add. So that's what I described on the front end. In a way, we'll also work on the back end. We have a long tail of countries that we work with as well. We have with Australia and New Zealand and South Africa for lobsters. We work with New Zealand for, again, hoki. We work with Sri Lanka. We work with Honduras, Colombia. So there are more like 25 odd countries which kind of contribute to, I think, maybe 20% of our overall supply. So that's the supply mix.
And you're largely a B2B supplier, so which means you're selling like white labeled product in a way.
No, we sell in our own brand. We only sell in two parts. Either we sell in our own brand, wherein the chef of that Michelin star restaurant knows that he wants to order a CenSea shrimp.
Okay.
Or he knows that a Mexican...
But CenSea is not a consumer brand, it's a B2B brand. Like chefs would know that CenSea is a...
Know.
Okay.
It is also in some tier 2 retail stores. Like if you go to a tier 2 retail, when I say tier 2, these are city level retail stores. They have maybe 20 stores, which as a segment is much smaller in the US, who don't have the scale to source their own private label shrimps.
Okay. Otherwise, like a Walmart and all these would have...
Walmart, they have their own private
private label. Okay.
The big boys have their own private label.
Okay.
So, yeah. So that...
And you would be selling to a Walmart also? Or Walmart has its own supply chain?
To Walmart. We do sell to, in that retail stack, we are now closing an acquisition which sells to Acme, Safeway, couple of rice choppers, like not tier 2, but between that, not a big boy, but between that. So we are getting there. Walmart is, yes, we would like to work with them, but eventually at some point. To your point, yes, we are somebody who could be relevant to them as well.
Okay.
Not necessarily that we run, there is nothing that we can offer to them.
So you were saying that there are two ways in which you sell. One is
our brand.
Yeah.
That is mostly to the food service side. Right? 100% of our food service business is in our brand.
Okay.
Or we manufacture private label for the retailers. That works mostly in the European side.
Okay.
Where we are the private label partners. They give all their product specifications. We manufacture for them in their label. We are now getting into our own branded business. So if I talk about, let's say, if I do this podcast, hopefully 2 years, 3 years later, I should be talking a lot about Captain Fresh branded business that we have built globally. We are just getting ourselves into our own brand. So in a way, where the way I had envisioned this is, like 5 years ago when I started, that this is a commodity. And the commodity is about scale. And the foundation needs to be hence supply chain. I think at $1 billion scale that we are, maybe as we move in 4-5 years, we should be $4-5 billion. We have built that foundation. And on top of this foundation is where we now can start thinking about the brand. And the thesis is very simple, Akshay. Actually, I live in Amsterdam now. I walk around on these retail aisles. I think except for air that we breathe here, I'm not exaggerating, except for air that we breathe here. Everything else, they're trying to put protein in it.
Yeah.
I am not exaggerating. Anything that goes into your body here has some protein in it. What actually makes me feel bad is in this entire protein revolution, seafood is like a stepmother, and it's like a side actor. You walk into a Humbo or a Albert Heinz here next to my house. Seafood is lying in some corner, some old frozen this thing in terms of where there is a dairy, the chocolate and the chips now, which are all protein embedded and they're all flashy and are in the packaged food section. Seafood is in some commodity aisle. I feel there is an opportunity there, right? In terms of really doing justice to what seafood is as a protein. Like in my journey today, Like a year ago, I would not have talked so passionately about it. In the last 1 year, if there is one product that has helped me come this far in my journey, right? To even think that I would have a six pack was impossible. You should see the pictures of mine 2 years ago, right? Seafood is a big play in that
Wow.
because
Okay.
if you have to control your calorie intake and maximize protein, seafood is the best product in town.
There's this
If
Silicon Valley term you might have heard called dog fooding, like eat your own dog food in a way. Like if you're making dog food, then you should be eating your own dog food. So you're literally doing that.
Yes,
Yeah.
I am
Amazing.
literally doing that as an afterthought because it's almost like I discovered as a customer.
Hmm. Hmm.
I have a trainer here who kept pushing me that, and then when he realized that I actually run a seafood company, I was like, dude, what is it asking to educate about your own product to you,
Yeah, yeah, yeah.
right?
Interesting.
So coming back to the thing that I see a huge potential for brand at a
Hmm.
global level, but
And
now I
this would
need
be a consumer brand. Like you would start selling
yeah,
direct to consumer on
no,
retail.
not direct to consumer, no.
I mean,
I
not
don't
direct to
believe
consumer,
in
but through
direct to
retail
consumer.
chains with your
Yes,
own
I
brand.
don't believe in direct to consumer.
Hmm.
There is
Like
no
in India, you have ITC or whatever. There are lots of other brands
yes.
which are selling.
Basically, I want to be the innovation champion in this category.
Hmm.
Like if I step back and see,
Hmm.
given the structure of the industry that we are in, if you compare our industry's R&D budget and dairy industry's R&D budget, a meat industry's R&D budget, we don't compare at all. Which is why I'll tell you an example. Let's say, for example, there is something called beef jerky that you get,
Yeah.
right? In
Yeah.
all kiosks here you get, right? That is actually a staple protein source for a lot of them
Hmm.
on the move.
Hmm.
Basically, they have made a snack out of this product
Yeah.
because they have obviously worked on product stabilization, shelf life, packaging, all that, and this is all a function of how much capital you have to
Hmm.
experiment on
Hmm.
R&D,
Hmm.
right? Our industry doesn't have that because the incumbents are very small. To give
Hmm.
you a sense, the largest player I have in this industry is $6 billion, whereas the largest player in poultry is $50 billion. In
Okay.
beef, is
Hmm.
$80 billion.
Hmm.
In dairy, it's $40 billion.
Hmm.
In fruits and vegetables, there is a dole. In grains, there is 100 billion. Right? Just the largest guy's R&D budget
Hmm.
could be higher
Hmm.
than my entire industry's R&D budget.
Hmm.
What that means is you make this thing compound over a 10, 20, 30-year period. You realize that why our category is so primitive. Why I am the stud in protein, literally. I'm the king, I'm the dude. But I'm thrown in some corner in a retail chain
Hmm.
because the industry insiders don't know how to sell it.
Hmm.
That's why a chocolate or a potato chips today is faking itself to be the protein champ
Yeah.
and appearing cool in front of customers. And this, I'm not talking about India. I'm talking about Amsterdam.
Yeah. Yeah. Yeah.
Amsterdam is amongst the top 5 cities. In fact, it's the top city when it comes to health aware population.
Hmm.
The percentage people who frequent 4 to 5 or 200 minutes plus gym time,
Hmm.
it's one of the highest
Hmm.
in the world.
Hmm.
Right? So the most savviest of demand, my industry is failing.
Wouldn't this bring you in conflict with your buyers? Like if you are a white label supplier to retail chains and you also
If I'm
start
doing
selling
the
your own.
same product, Akshay,
Okay.
which is why I brought the point of
R&D. Hmm. Hmm.
if I do the same product, I don't have a business doing it in my own brand.
Hmm.
It's waste of my
Got
time.
it. Okay. Tell me something. You live in Amsterdam. 90% of your sourcing is outside India. Probably 95% of your revenue will be outside India. Why do you want to list in India?
We are an Indian company. My critical capabilities are all based in India.
It just so happens that you are an Indian, therefore you hired your core team in India, right? Otherwise,
Why
you're
are
more
GCCs coming to India?
talent.
Exactly.
Hmm.
Right. Second, let me talk about the top 10 companies, seafood companies in the world. Everybody started from some country, they have to.
Yeah, yeah.
Right? At scale, what is the home country's contribution, whether it's on the supply or demand for each of them?
Not really. Like it's.
That's the nature of the beast.
Hmm.
I can't change the topography of the earth.
Hmm.
India can contribute if I need to be a all-weather supplier to my customer. I need to expose myself to 3 oceans. And in each ocean, if I need to be a all-weather supplier, I need to go into all coasts. Naturally, India becomes maybe one of the top 4 suppliers in Indian Ocean. No, I can't change that. Right? The sourcing mix will be what it is.
Hmm.
And if you look at demand side, if India was rich, obviously it would have made sense for us to stay back in India. And having said that, I truly believe in the next 5 to 10 years, we will definitely come back to India. Right? Because my theory is very simple. In India, the consumer categories that have been created, the players needed to have the ability to be the last man standing.
Right.
Whether it is a Kellogg's, whether it is even your, Bonvitas and Boosts of the world. Any of these category creation that's happened in India. That way, B2C businesses have a lot of share of voice. But if you really look at share of profits, which is why we today at $200 million can speak of 50 million profit. I let you do the research. You take the top 10 VC startups which have gone after B2C businesses and what is their EBITDA profile. You should strip out the treasury income.
Right.
Right. So coming back to the point, India is important for us, will be important for us, but we are now just following the return on capital employed as a framework and going after customers, which makes sense. And our ambition is to create that cash cow outside of India. At least that's what we will do in the next 4-5 years. And it's 1.5 billion people out there. If they start consuming, honestly, there's going to be very less fish outside for others. And that has already played out in China, by the way. China's emergence on the seafood market has been a tectonic shift in the global seafood landscape.
In what way?
So since China used to be a net exporter of products 10 years ago, I think maybe 12 years ago, today it's one of the largest importers of product. China consumes close to $100 billion worth of seafood. India consumes like 10 maybe. If India's 10 goes to 100 on a pro rata basis, even more, given our population is slightly higher, there is no supply in the world to cater to that growth.
Right.
So world has barely managed to absorb a China. If India lands up, it's not going to be as easy.
You're not doing anything in China. Again, the margins are not that high.
No, I am very focused on US and Europe because ease of doing business.
Okay. Ease
One
of doing
thing that I
business.
realized is, like I said, unknowns. You can't have those many unknowns. Whether it's China, whether it's South Korea, whether it is Japan, we are staying away from these 3 markets from a distribution standpoint.
Okay. Do you think about macro concerns, for example, global warming, for example, tariffs? Are these taking a lot of your mind space, or you feel like there is a lot which without these concerns, there is still enough headway for you to grow just through consolidation. So these are not really big concerns.
See, if you look at my origin, right, used to be an investment banker, wanted to get one of the seafood companies listed. So I went out in the market to do the roadshow for them, faced investor scrutiny on the business model that I was trying to pitch. And the business model that I was trying to pitch was basically one species, one origin, just from India, mostly going into the one market, which is US. Largely profitable, very, very healthy profits. But the questions were around sustainability of that. And my single biggest lesson out of that entire stint was that if you have to convert a commodity business like seafood into a packaged food business, the driver is predictability. And if predictability is the driver, the input for your business is it needs to be diversified. And diversified is across 3 vectors: species, origin stroke demand. Third is vertically integrated. You have an ability to play a role at the customer level and an ability to play a role at the farming or fisheries level. So this design choice is at the core of Captain Fish. Now, this design choice is so timeless in its effectiveness that it can withstand a tariff. It can withstand any of the other things that we talk about, currency. There is a war that's happening. So Suez Canal is blocked. Panama Canal is blocked. I don't care, because at the core of it, I can dial up, dial down any of these corridors that we operate in a matter of hours to weeks. Right? So that's at the foundation of our entire thing. That's why, US tariff happened. I don't think I mentioned we continue to grow, continue to deliver profit. We'll continue to do it. Venezuela is just now, actually, when you saying some investor asked me, what's our exposure in Venezuela? $1 million worth of seafood from Venezuela out of my 960. I just messaged. It's 1 million.
Wow.
Right. So that's the design piece that we have managed to do at the core of it. Actually, very few people understood the I would say the depth of this thinking before US tariff. I thank Mr. Trump for having done whatever he has done in a very obviously, I don't mean it, but whatever he has done, because he has brought out the beauty of our business model.
Because now you can choose low tariff countries to send products from.
Yeah, we did that. We did that in like 45 days. In fact, we played front foot. We doubled our inventory in the US. Because every small guy didn't have the ability to play the way we did.
Right.
So I'll give you a number. For first 6 months of this year, Asia used to be 2/3 of our supply going into the US. And in 2024, pre-tariff. In 2025, we flipped that. Asia became 1/3, LATAM became 2/3. Right. So that's the advantage that we work with. So I don't think this is a problem, because fundamentally, 100 years later also, Akshay, like this is what like Jeff Bezos says, right? It is not about what changes that entrepreneurs should chase. It's about what doesn't change. I don't think we can argue whether somebody will eat seafood or not eat seafood 100 years later.
Yeah.
Right? Somebody can argue whether they are eating shrimps or eating fish or eating tuna. That argument could be there. But they could argue how they are eating it. Right? But would they eat seafood or not? that argument I don't think is a valid argument. It's almost like, would you use a Gemini or Chat GPT or Anthropic or whatever that is? That question mark is there. Now those are already $1 trillion platforms, which have question marks in terms of whether they'll still be around or not. Right? Whereas us will for sure be around.
Yeah, amazing. So what's your IPO plan now? You pulled the plan previously, right?
Actually, it was actually a small technical part. We had done confidential filing. We were supposed to do public filing, and our public filing was planned around March 31st numbers. But we withdrew the IPO process so that we can do we have 2 acquisitions in the pipeline. We can do it flexibly from an equity swap standpoint, and then we'll refile as per the March 31st numbers. So the timeline almost stays intact, just that we have got ourselves a break from the process so that we can do some of the things that we are doing with some more flexibility. Otherwise, the process is not as flexible. You need to keep SEBI apprised, and actually the real bottleneck is whatever you do post filing, the size of what you do is coming as part of pre-IPO, and that pre-IPO is limited at 20% of what issue you are declared.
Okay.
And even an equity swap is counted as part of pre-IPO. So the deals that I'm doing, I had to rethink, because
what's the value of these 2 deals which are currently underway?
Both put together is around, on a top line basis, around $450 million.
Wow.
On a equity value basis, I think both put together around 65 million, I think.
Okay.
So, which meant that we breached the 20% mark. So, and I believe that doing this before IPO is beneficial to us than after IPO.
And of this 60 million, how much will be the equity swap and how much will be the cash?
I think like 20-ish would be cash, or 25 is cash.
Amazing.
So, now there is a lot of demand for our story, Akshay. I think people are starting to realize the beauty of this whole platform.
What do you mean demand for a story? Like you're getting more interest of people who want to be acquired?
Yeah, I think we have a pipeline of 20.
You can like bump up, like for the owner of the business, he can be a part of a much bigger story under the Captain Fresh umbrella rather than independent.
One is that, but look at it, right? He doesn't have an option otherwise. And these are folks who have not built the right transition structures. They don't have succession planned. And these are not the sexiest of businesses to attract a lot of blue chip talent.
I'm surprised there's no private equity roll-up play happening in this space.
There are a couple of private equity roll-up plays that are there, but private equity roll-ups has very narrow synergy potential compared to Captain Fresh.
Okay.
Their synergy potential is mostly on chopping and slicing the existing stuff that they have, which
more financial engineering.
More financial engineering. What I think we really disrupt this model is when we bring in the supply side unlock, which is almost 1:1. For an EBITDA of $1 that I do, in fact, more than 1:1, I can unlock almost $1.5 of EBITDA on the back end. So even if I screw up royally on the deal, I'm still, not losing my shirt as a Captain Fresh. Whereas a private equity doesn't have that luxury, which is why private equity in this roll-up play in this space hasn't really played out in a big way.
Would your target companies be happy getting equity which is listed in India?
Why not? In fact, you look at where do they invest?
I mean, India doesn't have so much of that free capital convertibility, the ability to put money in out? Like I believe that it is not as open as, let's say, like a US market.
Of course, it's not as open as US because
Hmm.
US deals in dollars, whereas we deal in rupees, so there's always conversion. But I think for a 5 trillion market cap, today India is a very, very safe place to be.
Okay.
Because FIIs take money in and out at their whims and fancies. I don't think
Hmm.
today you need anybody's permission to take your money out.
Hmm. Hmm. Hmm.
So from that standpoint, the quantum we are talking about is not something that will shake the market, right?
Hmm.
If we are talking about a market cap of 1.5 billion, I think the guys that have swapped their stake today have around 7% ownership in my company, right? So
Okay.
that is, let's say we talk about $100 million ownership. Obviously, they won't take it out at the same $100 million. Let's say they take it out over a 4-year period, which is 25 million, right? But 25 million taking there, you seen the kind of money that's returned from India. It's running into tens of billions of dollars. So, in fact, this is how I explain Indian market. This is a concern that a lot of them have. Of course, selling Captain Fresh starts with selling India to begin.
Yeah,
Indians.
right. Yeah, yeah.
So 25 million today, we show numbers that why it's not a point of concern. There is so much depth in the market today. And we also come from the other side, saying that where would you invest? You would invest in a fund. Where would they invest? Where is a BlackRock going? Where is a Fidelity going? What is their emerging market exposure? Where is Morgan Stanley going? So why you do want to do that thing of you going there and they coming to us? It's all the same. And you understand this industry.
Yeah. Amazing. Thank you so much for your time, Utham.